The silver market has been nothing short of chaotic. The swings are violent. The narratives are conflicting. And if you're feeling uncertain about what is actually happening beneath the surface, that is not weakness, that is awareness. Drop a comment. Just 3 words. Bullion beyond. That is it. Tells me you're here. Tells me you're paying attention. And that is all I need to know. Now, before we get into what just happened with silver lease rates and why this matters more than most people realize, I want to address something directly. A lot of you came here looking for answers. Some of you came skeptical, thinking this would be another hype channel pushing the same recycled narratives you have heard 1,000 times before. That is fine. Stay skeptical. But what you're going to get here is not hype. It is not fear. It is not an agenda. It is the raw picture. Backed by data you can verify yourself, and once you see it clearly, there's no going back to the noise. Let us start with what actually happened this week, because the data from the silver lending market is telling a story that very few people are connecting to the bigger structural picture. Silver lease rates spiked again. Not a small move, not a technical blip, a genuine disruption in the interbank lending system that underpins the entire paper silver market. The 1-month silver lease rate, the cost for bullion banks to borrow physical silver from each other, jumped sharply for the second time in less than 3 weeks. When lease rates spike like this, it means one thing and one thing only. The banks that normally lend silver to each other cannot source enough metal to meet internal demand. Here is why that matters structurally, and this is the part most people watching the silver market are still not understanding. The LBMA, the London Bullion Market Association, is the hub of global precious metals trading. It is where the world's largest bullion banks settle physical metal transactions between themselves. Under normal conditions, these banks lend silver to each other quietly, internally, without needing to advertise or go public. The lease rates remain stable because the informal network has enough above-ground inventory to handle demand. But when that internal lending network seizes, when the banks can no longer source metal from each other privately, they have to go public. And that is exactly what we are seeing right now. The spike in lease rates is not a forecast. It is not speculation. It is a documented market event showing that the cushion of available above-ground silver inside the interbank system is gone. And this is the second time in 3 weeks this has happened. Let that sit for a moment. The world's most liquid precious metals market, the system that is supposed to have infinite paper liquidity, is struggling to find physical metal to settle its own internal obligations. Now connect that to what has been happening on the COMEX, the futures exchange in New York where most Western silver contracts are traded. Registered silver, the metal that is genuinely warranted and available for immediate delivery against futures contracts, has been sitting dangerously low for weeks. No significant inflows. The March contract is rolling into May, but the pace is too slow. Open interest, the total number of contracts that could theoretically demand delivery, still sits at levels that dwarf the available registered inventory. The math between what is owed on paper and what is actually sitting in deliverable form does not close quietly. And here's where it gets interesting. While the COMEX registered silver sits flat with no new metal entering the pool, and while the LBMA lease rates are spiking because banks cannot source inventory internally, the price of silver is holding structure. It is not collapsing. It is not breaking down despite multiple headlines that should have triggered panic selling if this were a normal market environment. Ask yourself this. If the physical metal is genuinely available in the quantities the paper market claims, why are lease rates spiking? Why are the banks that settle billions of dollars in silver transactions every single day suddenly unable to lend metal to each other without going public and paying elevated rates? The answer is straightforward, and it connects directly to something that has been building for years, but is only now becoming visible in the data to anyone paying close attention. The silver market has been running a structural deficit for 6 consecutive years. Annual mine production globally is approximately 800 million ounces. Industrial demand alone, not counting investment demand, not counting jewelry, not counting coins and bars, just industrial consumption, is absorbing the majority of that supply. Solar panels, electronics, electric vehicles, medical equipment, water purification systems. These are not discretionary uses. These are applications where silver cannot be substituted without significant performance loss. And the demand from these sectors is not slowing down. It is accelerating. The Silver Institute, an industry organization that aggregates supply and demand data from mining companies, refiners, and industrial consumers, projects a deficit of nearly 300 million ounces for this year alone. That is more than a third of total global mine production disappearing into a supply gap in a single 12-month period. That is not a rounding error. That is a structural imbalance that cannot be papered over indefinitely with forwards, leases, and rehypothecation. And the lease rate spike is the first visible crack in that system. Now here's what most people miss about lease rates, and this is where understanding the mechanics separates the ones who know what they're looking at from the ones who are just reading headlines. When a bullion bank needs physical silver to settle a contract or meet a client obligation, it does not go out and mine new metal. It borrows existing inventory from another bank or from a central bank vault. That borrowed metal is leased at a rate similar to how you would pay interest on a loan. Under normal conditions, that rate is low because there's plenty of available inventory sitting idle in vaults waiting to be lent out. But when the available inventory shrinks, when the banks that normally lend silver suddenly need to hold onto their own stock because they see tightness coming, the lease rate rises. It is basic supply and demand applied to the lending market for physical metal. A spiking lease rate means the lenders are either running low on inventory or they are refusing to lend because they anticipate needing that metal themselves in the near future. Either scenario points to the same underlying reality. There's not enough above-ground available silver to meet the obligations being created in the paper market. And this is not the first time we have seen this pattern. In early 2021, when retail investors drove a short squeeze attempt in silver, lease rates spiked for the same reason. The banks could not source enough physical metal to meet delivery requests and internal settlement obligations. The difference this time is that there is no coordinated retail buying frenzy. There is no social media campaign driving speculative demand. The lease rate spike is happening in a relatively calm market environment, which tells you that tightness is structural, not speculative. Howard Marks wrote in Mastering the Market Cycle that the most dangerous moments in any market are not when everyone is panicking. They are when the underlying structure is deteriorating while the surface remains calm. The lease rate spike in a stable price environment is exactly that moment. The system is showing stress in the data, while the headlines are still explaining it away as noise. Now, let me give you the honest countercase, because this is where the ones who do their homework separate from the ones who just want confirmation bias. A stronger dollar creates mechanical headwinds for dollar-priced metals. If the dollar rallies on safe haven demand or Fed policy expectations, silver can face selling pressure regardless of the physical market tightness. Lease rate spikes can be temporary. Banks may source metal from alternative suppliers, central bank lending programs, or secondary market recycling within days or weeks, which would normalize rates without requiring a significant price move. And some of the supply deficit projections are based on institutional forecasts, not realized outcomes. Mine supply can respond to higher prices. Recycling rates can increase. Industrial users can shift to alternative materials in some applications. These are real variables, not excuses. Anyone managing actual capital has to account for them, but here is what separates a temporary lease rate blip from a structural breakdown. And this is the part you need to watch closely over the next several weeks. If lease rates spike once and then immediately normalize, that suggests a short-term liquidity issue that was resolved through normal market mechanisms. But if lease rates spike, settle briefly, and then spike again within a short window, that is a pattern. That is the market telling you the underlying problem has not been solved. It has only been papered over temporarily. And we are now seeing the second spike in 3 weeks. That is not random. That is not coincidence. That is a structural signal expressing itself repeatedly because the fundamental issue, the mismatch between paper obligations and physical availability, has not been addressed. The ones who track these patterns in commodity markets know exactly what this looks like. It is the early stage of a supply squeeze that has not yet expressed itself fully in price because the majority of market participants are still not paying attention to the lending data. Jeffrey Christian from CPM Group, a metals consultancy that works directly with bullion banks and central banks, has documented how previous silver squeezes began not with a sudden price explosion, but with quiet disruptions in the lending market that preceded the price move by weeks or months. The banks see the tightness first because they are the ones trying to source metal to settle obligations. The retail market and the future speculators see it last, after the price has already started moving. If you are waiting for the price to confirm the shortage before you pay attention to the lease rate data, you are already behind. Now connect this back to what is happening in China, because the physical demand story is not just a Western phenomenon, it is global. In China, the world's largest industrial consumer of silver has been operating under conditions that very few people outside the refining industry understand. Chinese manufacturers who rely on silver for electronics, solar panels, and industrial applications have been structurally short the metal for months. They bought paper contracts, expecting to take delivery, only to be told the metal was not available when settlement came due. What followed was a scramble to source physical silver from wherever it could be found, which drove premiums in the Shanghai market to levels that made Western spot prices look cheap by comparison. At one point, Chinese buyers were offering $10 per ounce above London spot just to secure delivery. That is not normal. That is desperation expressed in price. And when buyers are willing to pay that kind of premium, it tells you something very specific about the availability of metal in the physical market versus what the paper price suggests. The mainstream financial media is not covering this. They are not connecting the LBMA lease rate spike to the COMEX registered inventory stagnation, to the Shanghai physical premiums, to the structural supply deficit. They are treating each data point as a separate isolated event with no broader meaning. But the ones who pull these reports themselves, who track the vault inventories, who monitor the lease rates, who watch the premiums in physical markets, see exactly what is forming. This is not a metal story. This is a structural breakdown story that happens to be expressing itself most clearly in silver right now because silver sits at the intersection of monetary demand, industrial necessity, and a paper market that has been writing promises it cannot keep for decades. And the lease rate spike is the canary in the coal mine. It is the early warning that the system built on rehypothecation, fractional reserve lending, and infinite paper creation is starting to meet physical reality. Jim Rogers wrote in Hot Commodities that the most explosive moves in commodity markets do not happen when everyone sees the shortage coming. They happen when the shortage is already here, but most participants are still operating under the assumption that supply is infinite because the paper market says so. Silver dropping from higher levels and still printing green monthly candles, lease rates spiking twice in 3 weeks, registered inventory sitting flat with no inflows, physical premiums in China running nearly double digits above spot. These are not separate stories. They are the same story told in different markets at the same time. Here is what this means going forward, and this is the only question that matters right now. If the lease rate spike was temporary, we should see it normalize within days and stay normalized. If it spikes again within the next 2 to 3 weeks, that confirms the pattern. That tells you the underlying tightness is not resolved. It is accelerating. Watch the LBMA lease rate data. It is publicly reported. Watch the COMEX registered silver inventory. It updates daily. Watch the Shanghai premiums when their market is active. These are not predictions. These are observable data points that tell you in real time whether the physical market is tightening or loosening. And here's the part that separates this channel from every other metals commentary you have probably encountered. I am not here to tell you what to do. I'm not here to sell you anything. I do not have a course. I do not have an affiliate link. I do not benefit in any way from your decisions. What I am here to do is show you how to read the data yourself so that you do not need anyone, including me, to tell you what is happening. The goal is not followers. The goal is thinkers. People who can walk into any market environment, pull the primary sources, read the structure, and arrive at an independent conclusion with unshakable conviction. That level of clarity takes time to build, but with a genuine desire to learn, 6 to 12 months is enough to get there. I have seen it happen with people who showed up knowing almost nothing. They learned to read the vault reports, they learned to track lease rates, they learned to interpret premiums and discounts across different physical markets, and now they do not need anyone to explain what is happening because they can see it themselves in the data. The silver market is not going to wait for permission. It is not going to announce the squeeze with a press release. It is going to express itself in the data first, in the lease rates, in the vault inventories, in the physical premiums, and only after that will it show up in the price. The ones who are watching the right indicators will see it forming before it becomes obvious to everyone else. And by the time it is obvious, the easy part of the move will already be over. So here's your homework. Pull the LBMA lease rate data for the last 30 days. Look at the spikes, mark them on a chart, then pull the COMEX registered silver inventory for the same period. See if there is any correlation between lease rate spikes and registered inventory levels. Verify everything I just showed you. The primary sources are there. They have always been there. The ones who look find exactly what the data shows, and they stop needing anyone to tell them what to think. Invest with logic, not hype. Bullion beyond, out and about.